All right, dropping down into the daily chart, same levels, just adding a little bit more detail in here. Inside this range, we may bang around for a few days or jump right out the gate and run into that premium wick on the weekly chart. This in here needs to stay open, in my opinion, because we've gained so much ground for them to come all the way back down into this area in here, problematic. And then it'd probably range around and chop in between the low of this 21,121 SIBI on the weekly and this gap in here. So it's kind of like a do or die. I'd like to see it remain bullish. Otherwise, it becomes very, very difficult, and we could start seeing it do these types of things if it gets back down in here. All right, dropping down into a 15-minute time frame. The red level here, obviously, you can see that is being carried from the higher time frame charts, so that it's going to be in the entire slides until we get to the last few. If it's an issue for you, you don't like the color, I don't care. Don't leave a comment, because I'm going to do it the way I want to do it, and you're just going to have to accept the way I'm doing it. All right, so you can see how we work these levels here. These are all the quadrant levels in that weekly SIBI, working around the 21,400 level or thereabouts. Now, if you look real close, you can see there is a big sell side liquidity pool resting around the 21,300 level. That might be an issue if we gap down, for instance, on Sunday's opening. If we gap down, I would look for them to take this low here and maybe even accelerate down into this low here. Okay, but we've already done enough damage down here that if they come down for these and start the rebrush, go back higher, that's fine by me. But to go below this low, and then we've already unsettled the sell stops over here with that run, made a higher high. So this is the only reasonable sell side liquidity pool raid that I think is useful. But if we go below this one, then we're probably problematic, and we could start seeing accelerations down into this if this gives up the ghost. Okay, so these are just scenarios that I'm weighing out before the new week opens. Nobody knows where the new week opening price is going to be. We don't know how it's going to gap higher, or if it's going to gap lower, or if it's going to open unchanged from Friday's settlement price. So speculating on the initial bias isn't 100%, the procedure that I would encourage you to do, because anything can happen. Something can happen somewhere in the world. Bombs are dropping, anything geopolitical, and cause a crazy opening gap that would be completely out of left field, nobody expecting it. So you have to submit yourself to 6 o'clock Eastern time, see where they open price, and then you can start weighing out all your scenarios. But I just gave you both scenarios that would give me, I guess, the narrative I would operate under if we gap in a lower gap opening. We're looking for that low and that low for the sell side, resting below that. To remain bullish, I don't want to see it below that low. So hopefully it kind of makes it clear. It's not that here's plan A, here's plan B, and whatever happens, I'm going to come back and cheer and say, see how right I am. This is a matter of weighing out what happens at Sunday's opening price. And you have to have a trading plan of how you're going to engage based on how the opening is on Sunday at 6 o'clock and what is pertinent in the market right now. What's available for liquidity. They left the high up here on Thursday. So if you look at that, there's a big pool of liquidity left up here, and they could have baited with this late sell-off before the settlement at 5 o'clock Friday. So we'll see. All right, dropping down to a 1 minute chart. Looking at this chart like this, while we're inside of that larger weekly SIBI, I want you to take consideration about how I teach first presented fair value gap for the AM session. So during the opening range of 9:30 to 10 o'clock in the morning, as I was teaching the concept, because it's around the model that I'm taught my son Caleb, I gave him very specific rules. So he would have to use the very first presented fair value gap that he could use would be at 9:31 Eastern time. Between 9:31 and 10 o'clock, the very first fair value gap that forms on a 1 minute chart, that is his gap to use. Extend that throughout the day and throughout the week, and you'll see how they're used over and over and over again. I mentioned at the time when I first introduced this concept, I said that he would learn by experience when he could use the 9:30 1 minute fair value gap. It would take some time in looking at certain things. So I'm bringing in that now because I executed on it on Friday. You can watch the video that was posted prior to this one. But I want you to consider this candlestick right here. Now, normally, this would be your first presented fair value gap. But there's a criteria that I'm going to show you when and how I use the 931 as the very first presented fair value gap. Now, there's nothing inherently wrong with using this one. You know, if you extend that throughout the day, eventually you'll get something over here in the afternoon, but you're going to discover that it gets real wild in here and it doesn't respect it as much as the level of that 930 1 minute candlestick. Right, so take a look in the lower right hand corner. You can see that the chart now is toggled to regular trading hours, RTH. Okay, so we're going to see the gap, the difference between previous day's settlement price at 4:14 p.m. Eastern time to where we open at 9:30 Eastern time the very next trading day. So it's not showing you all the fluctuations in price overnight in Asia, in London, and then before the new AM session at 9:30 Eastern time. So you have to be aware of that price action still, but you can't ignore regular trading hour structure, which is what we're showing here. Okay. So if you take a very close look at where we opened up from where we settled previous Thursday at 4:14 p.m. Eastern time, we have a very large premium gap. That opening price here does two things. Number one, it triggers initial desire to want to be a buyer, because a lot of retail traders just see the price being flashed on the screen. It's like, well, yeah, it's a strong opening. But what do we do after we open? That's what a professional perspective is, not where are we at in relationship from the previous day's close to today's open. That's retail. That perspective, that measurement of bullishness or bearishness is identified through that lens. But a professional sees it from where do we open at and how do we close based on that open. And you want to think about that for your sessions, not necessarily just limiting it to daily range in its entirety. You want to be thinking about from the beginning at 9:30 to say 11 o'clock in the morning Eastern time. So that's your AM session. Same thing for the afternoon. Where do we start trading at 1:30 p.m. Eastern time for that opening range for the PM session? What's that opening price? The very first tick at 1:30. Then where we close at 4 o'clock. That could be your entire afternoon range. And where we open versus where we close, that's the professional measurement of the lay of the land, how the market is delivered. So simply stated, we have a very high premium opening here. But if you're looking at regular trading hours, you're going to see that they opened it up above regular trading hours, relative equal highs. So in here, we have Thursday's regular trading hours, buy side liquidity. And now looking at this right there, this is your first presented fair value gap, because it's done a raid on previous regular trading hours, relative equal highs, And now with that opening here, we measure the opening range gap to find the consequent encroachment of that. As soon as we get the opening price right there, boom, you know that you're looking for 70% likelihood it's going to pull back into that opening range gap, 50% of it. Okay, so that's important to understand. When we see this, it's almost as if you have x-ray vision and you can read what price is reaching for and how it's engaging liquidity from both the regular trading hours market structure and also incorporating the same ideas with the electronic trading hours market structure, which we'll look at in a moment. But this right here, that consequent encroachment is that level right there. So it comes up later on, hits it. And if you look real close, there's going to be minor buy side liquidity rating here. So this white box is the opening range gap for the AM session. So that's 9:30 to 10 o'clock, that measurement. And we're looking for where we settled previously, which is here, and where we open. And that's what we're showing a depiction of that. Okay. So we're blending two elements there, time and price. And we're also blending in the elements of regular trading hours, time, and market structure, and electronic trading hours and market structure. So what do I mean by that? Well, before we do that, I want you to notice that we have all this run up in here without having the need to take out that low. I want you to take a look in this little area right in here and see if there's anything useful that you might see as, obviously for you, it's going to be hindsight, but for an educator's moment to point out something to observe before we get further into the video, inside this area in here, if you don't take this low out and you're expecting the market to break down, what might you consider in this little area in here? Pause the video. I'm not going to pause the video, Michael. It dropped down to the 1 minute chart. Now I had this compressed and I'm showing it through electronic trading hours now. So I've toggled my ETH, RTH back to electronic trading hours. I have the range shown here that makes the opening range gap. That's that white shaded box here. If we're looking at how the market trades from regular trading hours and electronic trading hours, you have to look at the stops that are there. You have to look at how the market delivers to inefficiencies, from inefficiencies to liquidity, from liquidity to inefficiencies, and stripped down. Let's just say you were looking at just the electronic trading hours only, and you didn't even refer to regular trading hours. I teach you that going back from pre-market session, 7 o'clock in the morning Eastern time to 9:30 opening bell, that 90-minute window of time, that could be your entire trading canvas where you do all your work there and you don't care what it does after the opening bell. There's plenty of opportunities to do that. Or you want to use a session trading to give yourself a little bit of a buffer and then trade heavier handed after you get the opening range and the true understanding of where the market's going to go after 9:30 opening. That's a little bit more advanced. That's what I usually do when I'm running up the accounts. I'll do things like that. I'll build in a buffer right before the major session I'm looking to trade. And that might be the afternoon. It might be I'm not trading in the morning because FOMC rate announcements coming out later in the afternoon. So I will do very, very little light-handed trading pre-session because I know usually the morning session is going to be quiet, lethargic, choppy. And then after the initial distribution of price higher or lower at the 2:30 conference when they're now going to listen to the Fed chairman speak, that's usually the real move. And because I've done something early in the day, I've patted myself out. I would be willing to risk 50 to 75% of whatever I earned in that light-handed trading to leverage into what I think is the real move in the afternoon. So these are some of the things that I like to do and how I use planned leverage and light-handed trading where I build a little buffer for the real big impactful event that I'm trying to actually trade that day or session. But if I take your attention back to some of the things I've taught, using the obvious pools of liquidity that they cannot hide it from you. Okay, you don't need level 2 data. You don't need volume profile. You don't need any of that stuff. Okay, you don't need none of those things. But it makes you feel and look intelligent in the eyes of other people. When they look at your chart, it seems scientific, but it's simplistically shown by looking at time first. So if we're looking at the 9:30 opening range, Eastern time for equities open, going back in time, what's the first thing you're going to run into? London sessions liquidity. Well, here you go. Here's London's low. What happens prior to that? Asia's sessions low. So those are two levels that we would be looking for when we have the market opening up, trading above this short-term high, this short-term high here, and then bumping it right there at the open. So just think about that for a second, okay? We have a blending of regular trading hours and electronic trading hours to see kind of like an envelope, a barrier at which we want to see price reaching for obvious pools of liquidity that doesn't need level 2 data, is pointing to where was the high at, where was the low at in the Asian session, in the London session. And now we're building them for the morning session that can be used for the afternoon or lunch macro. So this little bump up here, taking out that high, that's something I pointed out to in one of my students' live streams, Dasha. You know her as Lumi Traders. So I shared that. I said I ran the buy stops here, and now I'm going to be looking for 21,360, and that's based on London low. Okay. So I have witnesses over there that'll corroborate and say, yeah, he did that. But without having the need to do that type of thing. I mean, obviously I've been doing this enough now. If you've been following me, if you're a student, you know that there's no hindsight required. I'm pointing to these things. I just want you to look for these types of conditions, these setups, these parameters, so that way you can start to formulate a routine that you follow every single session. You're not trying to reinvent the wheel. You're not trying to complicate it. You're not trying to bring every tool, every aspect of whatever I've taught into every situation, because every situation doesn't warrant every PD array, every school of thought that ICT's ever codified. And that's you as a student, or that's someone that doesn't want to learn how to use this stuff. They just see all these tools, these concepts, these procedures, and they think, oh, who's going to do all that? Well, there's no application ever by me or a instruction by me to try to throw everything I have into every situation right now. Looking at a chart, you're not going to have every PD array there. That's why knowing all of them generally is a good thing, but you're going to specialize in one or two, and that's all you need. And your setup might not form that given moment, and you let it go, and you trust that you'll find another setup. Or, and this is my hope, that you'll learn a lot of the continuation patterns that I teach with PD arrays, like volume imbalances, mitigation blocks, institutional order entry drills, that type of thing. That's why it's beneficial for you to know, like month 4's content in my core content mentorship lessons. You can find that on the YouTube channel, where I'm teaching the PD array matrix and the general introduction to the basic PD arrays. Not all 81 of them, but just the most pertinent ones that I think that's going to be easy for the majority of all of you as retail traders, being able to see that in price action and how useful they are. So I want you to take a look at this. Buy side liquidity here, taken. Buy side liquidity here, taken. Buy side liquidity here, taken. And we're seeing this occur in electronic trading hours that leads to that big pump up that keeps us above the relative equal highs in the regular trading hours. Remember, we're looking at electronic trading hours here, okay? So this is one of the things that new students with me, or those that maybe already trade but never know how to consider regular trading hours versus the effects of electronic trading hours market structure. You have to blend both of them. And if you think that's a complication, I'm sorry, but it's going to require a little bit of thought. Okay. You're trading against the most elite minds in the financial world's markets, arena.